If there's one thing that all of us investors can agree on right now, it's the fact that the near and medium term for the US economy, or even the global economy, doesn't look all that great. Debt is climbing at an alarming rate. Unemployment is likely to tick higher. We're starting to see GDP start to slow. All signs pointing towards a potential recession on the horizon. To think the economy was all that strong the past few years would also be a false narrative. Also, because more than 50% of all the gains in the US stock market the past 2 years was related to 7 stocks, the Magnificent Seven. So given all that, we are truly starting to see the importance of a few things that I talk about on this channel on a regular basis. The importance of being well diversified, the importance of investing in high quality companies. Those companies right now that have weak balance sheets, if we do in fact go into a recession, those are companies that are going to get hit rather hard. Companies that have strong balance sheets are going to be able to come out of this even stronger. When it comes to managing your own portfolio, the fact of the matter is you or I can't control macro environment factors. We can't control trade policy. We can't control global tensions. We cannot control anything going on in the economy. As such, we have to invest based on facts. And the facts of the matter are right now, there's a global trade war going on between the US and China. We have a lot of tariff stuff going on. We have a slowing economy. So with all of that, if we continue down this path, we are likely headed towards a recession. Now, as a manager of your own portfolio, you need to protect your portfolio. You need to prepare for a recession. Does this mean we need to sell out of everything in our portfolio and start fresh? No, absolutely not. But it does mean you have to make some tweaks. You need to get a little bit more defensive if you in fact think that we are headed down this road. As such, in today's video, I'm going to show you how you can prepare. What sectors should you be investing in? What are some examples of ETFs? What are some examples of some defensive individual stocks to invest in? So make sure you stay tuned throughout the entirety of today's video. And before we do, show me your appreciation by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to check out their 10 best stocks to buy right now. All right, let's jump back into our video talking about preparing our portfolios for a recession. A recession that seems like it's more and more likely as the weeks go by. And it's something that can be worrisome, especially to new investors. But I'm here to tell you that it's part of the cycle. Recessions happen periodically. There's a lot more green years than there are red years, but we have to go through these. It is healthy and part of the cycle. So looking back at prior recessions, there's things that you can learn from those. We see investors move out of highly cyclical, high growth areas, and they tweak and move a lot of their money into defensive sectors. And you might be asking yourself, well, what are some of those defensive sectors? They're going to include things like consumer staples, healthcare, and utilities. So with that, in today's video, we're going to be covering those exact sectors right now. I'm going to give you an ETF to look at in those sectors and an individual stock. And no, today's video does not include SCHD, although I do think that is a great ETF to invest in through this period, this downturn, this possible recession. So let's kick things off by starting with the consumer staples. And the largest ETF within that particular sector is going to be the Select Sector SPDR Consumer Staples ETF, stock ticker XLP. It currently has assets under management of $15.7 billion, an expense ratio of 0.08%, so it is a low-cost fund. Over the past 12 months, the ETF is up 11.5%, and year-to-date, it is up 4%. This is a sector-specific ETF, so it should not come as any surprise that it's made up of primarily consumer staple stocks. The top 10 holdings include Costco, Walmart, Procter & Gamble, Coca-Cola, Philip Morris, Colgate, Mondelez, PepsiCo, Altria Group, and Kimberly-Clark. In total, the ETF has 41 positions, with the top 10 making up 62% of the ETF. In terms of an individual stock within the consumer staples sector, I'm taking a close look at PepsiCo right now. In that beverage space, I've long liked Coca-Cola, and that's the position I own. But looking at valuation right now, PepsiCo looks quite intriguing. Pepsi shares are down 15% over the past 12 months and down 6% in 2025 alone. In addition, with Pepsi, you get some stable growing cash flows via a dividend, which currently yields 3.8%. They have a 5-year dividend growth rate of 7.25 and 52 consecutive years of dividend growth, making them a dividend king. And right now, shares look pretty cheap. The stock trades at a forward PE multiple of just 17.3 times, well below their 5-year average of 22.6 times. In terms of EV to EBITDA, shares currently trade at 13.9, which is the cheapest valuation in more than a decade for this stock. This compares very favorably to their 5-year average of 17.4 times. So that's consumer staples. What was another defensive area to look at for your portfolio preparing for a recession? It's definitely going to be healthcare. And the largest ETF within the healthcare sector is going to be the Healthcare Select Sector Spider ETF, also known as XLV. The ETF currently has assets under management of $35 billion, an expense ratio of 0.08%, and over the past 12 months, shares are down 2%, year to date, down 1%. Again, this is a sector-specific ETF, so all the positions are healthcare stocks. And the only reason that this particular ETF is in fact down over the past 12 months, and especially down year to date, is due in part that UNH happens to be their second largest position. It just had one of its worst days on record when the stock was down over 20%. So if you're not yet in this ETF, now may be a great time to add. The top holdings within the ETF include Eli Lilly, there's United Health that we just talked about, Johnson & Johnson, AbbVie, Abbott Labs, Merck, Intuitive Surgical, Thermo Fisher Scientific, Amgen, and Boston Scientific. A ton of names that I like in general. In total, the ETF has 61 positions, with the top 10 making up 57% of the entire ETF. This is the ETF that I really like a lot and think it makes a ton of sense. It's not currently within my portfolio, but definitely one that don't be surprised if you're an Edge Plus subscriber in my newsletter that you see this added to the portfolio very soon. In terms of an individual stock within the healthcare space, there's a slew of names that I could talk about. It could be a Johnson & Johnson, an Eli Lilly, a Merck, an Amgen. But it shouldn't come as much of a surprise that the one I'm going to talk about happens to be one of my longest held positions, which is AbbVie, stock ticker ABBV. And when it comes to AbbVie, you have heard me talk about them before, that I refer to them as an investor's trifecta, a stock or a company that can add solid share price appreciation, a solid dividend yield, and strong dividend growth. Over the past 12 months, the stock is up 5%, and on a year-to-date basis, down 2%. So we're starting to get a better entry point if you're not yet in the stock. Here's a look at the dividend, where it currently yields 3.8%, a 5-year dividend growth rate of 7.2%, and 11 consecutive years of dividend growth. Almost identical dividend stats to that of PepsiCo. In terms of valuation, as I mentioned, the stock was at a high of 216 not too long ago and has since fallen back to the low 170s, so certainly looking more intriguing. The current forward PE multiple is 14.2 times, which is actually above their 5-year average of 11.2 times, but this is a stock that should be trading closer to a 15 times multiple. And I've talked about this before, that AbbVie is kind of going through the same trajectory that the likes of a Merck and an Amgen have been through, as they have to go through this kind of prove it period. And AbbVie has certainly proven it. Thus, it receives a higher multiple than in years past. The final defensive sector that we're going to take a look at today is going to be the utility sector. And when thinking about defensive sectors, the easiest way to think about it is, where do consumers have to spend money? Well, we all need to eat, hence consumer staples. We all need to take care of our health, hence healthcare. And we need to have the lights on, hence utility sectors. However, we do not need to go out and buy that new car. We do not need to go out and buy those new set of shoes, that new wardrobe, hence why consumer discretionary tends to take a back seat. those are more cyclical areas. So when looking at utilities, the largest utility ETF is the Utilities Select Sector Spider ETF, stock ticker XLU. Currently has assets under management of $17 billion, an expense ratio of 0.08%, making it a great low-cost option. And over the past 12 months, it is up 21%, and year-to-date, up 3%. This is a sector-specific ETF, so again, no surprise, it's made up of all utility companies. The top holdings include NextEra Energy, Southern Company, Duke Energy, Constellation Energy, American Electric Power, Exelon, Sempra, Dominion Energy, Public Service Enterprise Group, and Xcel Energy. In total, the ETF has just 34 positions, with the top 10 making up 56% of the ETF. In terms of an individual stock within the utility sector, I only own one, and that's the one I'm going to talk about. It is NextEra Energy, stock ticker NEE, which also happens to be the largest exposure to XLU that we just looked at here. I look at a company like NextEra Energy, which is a massive utility company out of the state of Florida, but they're also a dividend compounder and a compounder of wealth. Over the past 12 months, the stock is up 4%, but year-to-date, down 7%, giving us another chance to add to this great stock. They are a utility company focusing on renewable energy, primarily solar and nuclear. Here's a look at the dividend I just mentioned. The dividend yield currently sits at 3.4%, a 5-year dividend growth rate, a strong 5-year dividend growth rate, I should say, of 10.4%, and 29 consecutive years of dividend growth, making them a dividend aristocrat. In terms of valuation, the stock looks very intriguing at current levels. Forward PE sits at just 18.1 times compared to their 5-year average of 24.4 times. The EV to EBITDA sits at 16.3, well below their 5-year average of 19.3 times. A lot to like about this stock with or without a recession. In terms of the dividend for all three individual stocks that we looked at here today, they're almost identical. Very solid dividend yields, and you're getting dividend growth. And again, when I'm looking at dividend stocks, I'm focused less on the yield and more on the dividend growth, because that's what puts the power of compounding into overdrive. So there we just talked about 3 ways that you can add some defensiveness to your portfolio to prepare your portfolio for a recession: consumer staples, healthcare, and utilities, ETFs, or individual stocks, whichever route you want to go. Down in the comment section, let me know what you thought of this video. What is your favorite ETF that we talked about? And what is your favorite individual stock that we talked about? And if you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.